Hello everyone and welcome to the first episode of the FMG syllabus, which is going to be a range of videos from the absolute basics and just a more in-depth, detailed look at how I approach the market. So I'm not one to really waste time, so I just want to get straight into it. Of course, the biggest change you can currently see right now is my charts they're all one color now. The reason behind that change is, for me, red and green or black and white, whatever you do use, for me, they're very emotive, especially red and green. If you've got a bias of a bearish or bullish, long or short, having red or green candles will kind of give you a predefined bias or predefined focus on what price action to look at or what structure to look at because of the colors. The colors from an early age have subconscious meanings to us. So for me, I feel like it just does more harm than good. And because of the way that I approach the market, the main thing I need is structure. That's the key component of our approach to the market. So colors aren't really essential to me. So what I'm going to do in this first episode is just go over how I approach the market from a top-down perspective, and we're going to get more detailed as we go on. So you can see, first things first, we've got this bullish market from obviously February 17th up until February 18. So about January to February. So 17 to 18 market was bullish. 18 February down to now, we've obviously been in a bearish market. So when we have a look down in our weekly chart, of course, you can see the most important aspect of my approach is obviously the key levels. So you can see it is the most tedious part, as applying all the lines does take, say, roughly 5 to 10 minutes. But 1.4, 1.35, so every 500 pips for me is a key level. Every 250 pips is a quarter figure. So for me, it's just showing me whether or not price is still going to continue, because price on a whole moves from a range to a range. So you can see even through the price action that we've shown, price was around 1.05 to 1.075, 250 pips. Once we broke clean above 1075, we rallied straight to 1.1, 1.12, 1.15, 1.17. We came back down there to 1.15. We rallied back up. And you can see from when the bear market began on euro dollar, price was range bound between 1.25, which is a massive key level, and 1.225. So as soon as we had a strong break below 1.225, you can see price has moved from range to range and continues to move down. So what I'm going to do is highlight how I think about price, so you guys can understand how I think about price, so you can understand how I look at the market and the reason behind the decisions I make or the trades I take. So with euro dollar right now, you can see we had three strong attempts to break through 1.25 before we drop. So as you guys know, I'm a swing trader, so the higher time frame direction for me is vital to knowing what side of the market to be on. So I'm going to get more precise as I dive in, but I just want to have a kind of overview. So either way you look at it, you can see euro dollar right now is consolidating. We're not really having any direction. So following this long rally up we had from 17 all the way up into end of 17, going into 18, then all of a sudden now we've paused. So for me, this is a redistribution of buyers turning into sellers, because now the market on a whole has reached the area of too high. So that's what it's being viewed as now. But that doesn't necessarily mean we're going to become bearish, which is why we have to wait for confirmation. So when we dive into our daily chart, and like I say, let's have a walk back through time, we get to look at euro dollar in a different view, especially for me now, because like I said before, I only have one color. So it's very easy for me to have a look. So daily chart is more often than not my favorite time frame. So when we're looking at euro dollar, obviously the lower you go down the time frame, the more messy price starts to look. but you can see the multiple attempts to break through 1.25 and we fell. Upon that high being made here, you can see if we change our fib over to my FMG fib. So the rationale behind this fib is I look at price as a discount. So that's how I like to explain it to all my members. So above here is your level of invalidation above 100%. So that is the highest value of euro dollar right now. And 1.21 was the lowest value. So what you're looking for now is a pullback, or for me, what I like to call a sell, because you don't want to buy high, you don't want to sell low. So we want a discount. So I look at this as 38% off, 50% off, 60 to 70%, 70 to 80%, and obviously 90% off would provide you the best discount on price, even in a real life aspect. So from my back testing of things, price tends to reverse more often than not around the 60 to, I'd say 70, 80, depending on the volatility of the pair. So with euro dollar, we're more likely to only pull back around 60 to 70. With exotic pairs, it's more often sometimes 80s, even sometimes 90. So again, you have to take into consideration the volatility of the pair. But we can see from when our high and low was made, euro dollar first rejection around here. So we had a rejection here. Then we had another rejection here. And then we had a lower high form again here. So again, structure is key for me. So what that's showing me is we can't move higher. We're failing to move higher, especially after those daily, weekly attempts previous. So when we look at structure of euro, for me, I always say structure is the only thing that matters. So I don't like to be very precise. What I like to do is let the market breathe, let price breathe. So the reason why I use a channel when I'm drawing trend lines is because for me, when you're looking at price, trend lines, other forms of technical analysis, everyone has a different view, but price is always right. That's how I look at the market. So you can see buyer stepped in, buyer stepped in, buyer stepped in. So for me, I look at price like this. If we break below this region, so there's many ways to look at it. Some people look at it as an area of support. Some people look at it as higher lows. But if we break below this region, we are looking for price to continue to move lower. Now, the way that I would trade is we've seen that impulse down. So that's our A leg. We've seen the move down into our B leg. So now I'm anticipating price to form a lower high. So that's how I'm looking at my strategy on a daily chart. So when we see price forming a lower high around 60 to 70, like what we're hoping or predefining that region, we can see we've had again failures to move higher. So that's what all those wicks represent, price failing to move higher. So again, the key thing is risk to reward is the key thing that matters. And also price structure and the way of the characteristics of the actual price. So with all those failures to move higher, we look at where we would have gone short. So if we say to ourselves risk reward, we're going to go short, or we would have went short here. Don't try and beat the market. Sometimes people try and have a small stop loss for obviously a better risk and reward, which is what matters. But you don't want to get stopped out prematurely. You want to always make sure if you do get stopped out, then your trade was wrong. There's nothing worse than being right and still losing, which is why for me, I always do my stop loss at my level of invalidation. I wouldn't want to see price push back up past their first initial sell-off point. So again, another way to predict your risk and reward is you can either have the predefined fib levels that I have, -27, -0.5, -8, -1.08. So for me, key level now, I would be looking at 1.2. That would be my predefined target, just because, like I said, price moves in ranges. But if we take that away, a good way to think about a target is price repeats itself. So when price does find its high, we are then going to say we have a higher probability of price reversing back down in the first sell-off, as markets move in repetition. Markets are very repetitive because the market participants are very repetitive. So the first sell-off, we can add that on with our ghost tool here. So it's called a bars pattern. And we can look for, that offers us a 2.25. So you should never take a trade which isn't higher than 1% risk for a 2% gain. It should never be 1.15, 1 to 1. It should always be a risk in 1 to make 2 and more. So you can already see for me, 1.2 would have been my target, which offers me a 3.8. So if you guys go through the other material, you'll notice the strike rate that you need for that, etc., that I'll cover later. But from this point here now, we see markets start to trend. So once we see markets start to trend, we now take a step back and look at a higher time frame price action. So what are we seeing? A consolidation, a redistribution of buyers turning into sellers. So buyers are no longer as bullish as they were on the run up, and sellers are now starting to enter the market as buyers. So it's an exchange of hands. Buyers become less bullish, sellers enter the market, then sellers start to take over the market. So that's how you see the move down. So then you see we go from range to range. 1.75 becomes the resistance, we drop again. 1.15 becomes the resistance, we drop down, and now we're range bound again between 1.12 and 1.1. But let's walk through how we would have been taking some trades throughout this time. So our first, like I said, indication that price is going to reverse would have been in this region here. Once we have a break of there, we know now price is starting to shift. Our overall level of invalidation, so it's always to be clear that there's different levels or severities of bullish and bearish. So your overall level to say this market now has changed from bullish to bearish is the level of invalidation. This was your first pullback of support and support. So this is your area where once price breaks below this region, we now can completely change our bias from bullish to bearish on a higher time frame view. Then you see price starts to trade lower. We have a nice break and retest with a lovely shooting star pattern of 1.2. Again, we break down, so we're looking for those legs. So we have that nice pattern on the daily. We're looking for our first pullback, which will come into here. And this is the art of swing trading. Again, look at euro dollar, 61 to 7.2. It likes those pullback areas. We reject all the way down and we hit our target. Perfect reversal pattern. We pull back up. We get back above 1.5, but we know for us to change our bias again from bullish to bearish or from bearish to bullish, price must break above this high. We must see, no matter what happens on a higher time frame view, we must see price recover and get above this high and retest it, or a clean break above that doesn't come back like what we saw on the bearish side. We didn't get that. All we got was price moved all the way back up into the highest level of discount. So this is the best area of risk and reward. So it's always good to map out your level of invalidation. As long as price doesn't break above, it's just basically the best area to sell again. We see a little bit of corrective structure here. Price breaks down. This time we have a different, not so much of a pullback on the card. So me personally, I wouldn't have got into this trade because I more like to sell. Like I said, it's all about being consistent. I'd more like to sell in this region here. So the 70 to 78.6, because we've seen resistance. So I like a break, a retracement back into that area to look for shorts that didn't come. So you let that trade go. We're then looking for our next pullback up, which for me now, the more you zoom into price, the more you're looking at that characteristic of an A and a B and a C. So you see we have a nice one here again from that A leg down to that B leg. So we even had one here, A, B, C, A, B, C, A, B, C. So you see price is continuously in a bearish market. So all you're looking for is the perfect swings of A, B, C. Some are more perfect than others. For example, like this bit of price action here, you can see it's just lovely. A, B, C, and it just repeats itself right here. A, B, C. On this occasion, you would have been stopped out, but this was around fundamentals. So when fundamentals are in play, there's also an increase in volatility. So that means, like I said before, you may see greater pullbacks. So, but on this occasion, there was nothing you could do. But once we see price again offer us another opportunity, then we can start to say, okay, there's different types. So right now, I'm just skimming. I'm giving you guys an overall view of how I approach the market. Everything's going to get a lot more detailed. There's going to be so many more videos for you to understand how I approach the market. With structure is key. We see here, like I say to you guys, I like to give price a chance. So we see here, higher lows, higher highs, higher high. So we're expecting price to push up from this region here and create a higher high. That didn't come. So what are we looking for now? Price is now broken, so it's better to annotate it for you. So we got a low, we got a high, higher low, higher high. We're expecting price to make a higher low to then what? Make a higher high. We didn't get that. Price broke through. So now we're looking for a retracement, which we got for price to then make a low. Then you see we had a short pullback, drop down again. We got attracted to where? The next range, 1.1. So you can see price support will become resistance as price action continues to work out. As we're coming into present day euro, we even see here ABC, ABC. So you see it shows up a lot. ABC, ABC. So all that C leg should always be reversing or continuing back down. If price gets above that, then the setup is invalidated, and as you can see, price will continue to move in that direction. So this is just the first, what I'd say, episode, just for me to give you guys a skim, just a glimpse of a few of the characteristics that we're going to be introducing throughout this whole thing. We're going to be going over all of the main pairs that I trade. So Euro, Swiss, Pound, Aussie, New Zealand, CAD, Oil, UJ, Gold and Silver. Those are all the majors, what I say, because they have the dollar. And my cross pairs, what I look at is EJ, GJ, GA, GN, EA and EN. But no matter what market you're trading, the things that I'm going to teach you throughout this syllabus are going to be things that you can take with you and apply into anything trading related. In terms of EMAs, the only EMAs or anything outside of structure that I use is the 10 and 20 EMA, because usually you can see moving averages tend to give you mixed signals. So when you're, why I like the 10 and 20 is when you're looking at a macro chart, as you can see, higher time frame, we are still bearish. The only way we'll become bullish is if we break above 1.14200. That's the way my strategy tells me anyway. When we look at it on a weekly, it shows you weekly now, as it acts as dynamic support and resistance. It shows you weekly we're starting to show buyers potentially stepping in the market and may have a run back up to that level of monthly invalidation. When you go down into daily shows you when that short-term pullback is going to come into. So you see the way we went from a bearish crossover, bearish price action, bullish crossover, and now we started to trade bullish. 4 hour for me, I don't pay as much attention to it. If you are more of an intraday trader or someone that likes to trade just smaller market movements, you can also use it, because if you're looking from a bullish point of view, from our A up to our B leg, this currently says to me euro, we should be looking for euro to retrace back up to 1.12439. So again, you can see moving averages, they crossed over at the exact point. So if you wasn't bullish from the low, when price breaks above this high here, because we can see we was in that range, and also this previous support and resistance, we are now looking for price to trade higher. The moving averages predicted it just before, and literally a perfect prediction when it crossed over. Then we've seen price move higher. So your entry could be on that crossover here. Invalidation would be below your C leg now, because you believe that this is the lowest point in the market. And then you would be looking for, that's a 3.7, but you would be looking for price to come back up to 1.12500. So again, guys, this is just a little glimpse. In the next episode, I'm going to more highlight our actual strategy, highlight when it's valid, and also I'm going to give you a nice example of how to catch those long-term swings when we look at Aussie dollar, which is also a great pair. But I hope you guys have enjoyed this first installment. I'm going to try and keep each video no longer than, say, 20 to 25 minutes at maximum, because I know it's better to have 30-minute bursts at max so you can really take in the information. But I hope you guys have enjoyed this first episode, and look forward to the next one. Thanks for watching, guys.